Hey everyone, welcome back to Corporate Decoder, the place where we make sense of the money machines that run the world. And today we're digging into ITC Holdings Corp's Q2 2025 report. Get ready because this one's packed with a bunch of important numbers that tell a story about how this energy giant is managing its massive infrastructure and finances. And trust me, you'll want to see how they're balancing big investments with, well, let's just call them some interesting financial maneuvers. Before we dive in, if you appreciate getting straight unvarnished insights from these reports, hit that subscribe button and make sure to join our Discord community, link down below. We unpack these kinds of documents there all the time. So we're looking at ITC Holdings filing for the quarterly period ended June 30, 2025, and it's essentially their report card for that 3-month stretch. They're a company that owns and operates high voltage electricity transmission systems across several states like Michigan, Iowa, and Minnesota. And when you're talking about the backbone of the country's energy grid, that means big projects, big money, and big responsibilities. Possibilities are plepanumliv, because that's where the real story is. Looking at their balance sheet as of June 30, 2025, the company has total assets of a whopping $14.3 billion. That's a huge number, and it mostly comes from their property, plant, and equipment, which stands at over $12.6 billion. This really highlights the capital-intensive nature of their business. It costs a fortune to build and maintain the electric grid. On the liability side, they have total liabilities of over $11.12 billion, which means they're carrying a significant amount of debt. Their long-term debt alone is over $7.7 billion. That's a lot of borrowing. Now let's talk about how much money they actually made. For the 3 months ended June 30, 2025, total operating revenues were $444 million. This is a pretty solid increase of 10% compared to the same period last year, which was $405 million. For the first 6 months of the year, their total operating revenues were $84 million, up about 9% from $81.13 million in the prior year. So sales are definitely growing, which is a good sign. When we look at cash flows, things get really interesting. For the 6 months ended June 30, 2025, their net cash provided by operating activities was $346 million, which is a slight increase from $336 million in the same period last year. That means the core business is generating more cash. However, their investing activities show a massive outflow of $656 million in the same period last year. That means the core business is generating more cash. However, their investing activities show a massive outflow of $653 million for property, plant, and equipment. This is a huge investment in their infrastructure. A 31% increase from the $1,497 million used in the same period last year. This shows they are heavily reinvesting in their future. Now, here's where things get a bit complex and where the company's regulated nature really comes into play. They use something called formula rates, which basically means their prices are set by regulators, and there's a mechanism to adjust for actual costs. They had a net revenue accrual of $36 million for the first 6 months of 2025. This means they're essentially billing customers for more than they've collected from them in that period, which will be settled later. A big point of discussion in this filing is the rate of return on equity, or RBI. For their MISO subsidiaries, the authorized ROE was revised to 10.73%. This might sound technical, but it's super important because it determines how much profit they're allowed to make on their investments. Think of it as the regulator saying, this is a fair profit for the risk you're taking. And there's a long-running saga here with ROE complaints that have gone all the way to court. The FERC, or Federal Energy Regulatory Commission, has made several rulings, and a DC Circuit Court decision even sent things back for more review. The October 2024 order revised the methodology for calculating ROIND. The company is appealing some aspects of it. They've also made refund payments totaling $6 million in the first half of 2025 for these past issues, and the aggregate refund liability was $21 million as of June 30, 2020. This shows ongoing regulatory battles that can impact their finances. They also report on fair value measurements. For example, their interest rate swap derivatives, a way to manage financial risk, are valued. As of June 30, 2025, their interest rate swap derivatives had a fair value of $5 million on the liability side, and $1 million on the liability side, and $1 million on the asset side. This is a relatively small number, but it shows they're actively managing financial risks. Looking at equity, all their common stock is held by ITC Investment Holdings and ultimately by Fortis Inc. This internal structure means individual investors don't directly own shares in ITC Holdings. Their retained earnings grew to $2.799 billion, a healthy sign that they're keeping profits in the business for future growth. There are also related party transactions mentioned. They pay dividends to ITC Investment Holdings and engage in tax sharing agreements. For the 6 months ended June 30, 2025, they had $9 million in charges billed from Fortis and Fortis affiliates. These are essentially costs for services provided by their parent company or related entities, which is standard for companies with complex ownership structures. Their segment information breaks down performance between their regulated operating subsidiaries and ITC Holdings and other. The regulated operating subsidiaries are the workhorses contributing the vast majority of revenue and assets. For example, for the 6 months ended June 30, 2025, the regulated operating subsidiaries generated $902 million in operating revenues, while ITC Holdings and other had virtually none. This confirms their core business is transmission services. The company expects a long-term upward trend in their rate base due to ongoing capital investments. They forecast $5.8 billion in capital expenditures from 2025 through 2029. This is a massive commitment to upgrading their grid. They're also monitoring global trade policy and their potential impact, saying they don't expect a significant financial impact in 2025, but are keeping an eye on it. It's noted that actual monthly network peak loads affect the timing of cash flows from transmission services. This means that weather and economic factors can cause fluctuations in when they get paid, but it doesn't impact the total revenue they eventually recognize. For the 3 months ended June 30, 2025, network revenues were $310 million, making up 70% of their total. The breakdown of operating revenues shows network revenues are their bread and butter, bringing in $625. Regional cost-sharing revenues are also significant at $219 million. These numbers demonstrate the core business model is stable. Now let's shift gears and talk about the overall financial health and strategy based on these numbers. ITC Holdings is a utility company, and that means its financials are heavily influenced by regulation and massive long-term investments in infrastructure. They are essentially building and maintaining the arteries of the energy system. From a shareholder's perspective, given that all shares are held by ITC Investment Holdings and ultimately Fortis Inc., there aren't direct publicly traded shares in ITC Holdings itself. However, understanding their financial performance is crucial for the parent company and for investors in Fortis. Let's talk about the strengths. Their revenue is growing and their core business of transmission is essential infrastructure, so demand is likely to remain strong. Their massive investment in property, plant and equipment shows a commitment to modernizing and expanding their network, which is key for future growth and reliability. On the flip side, the company carries a substantial amount of debt. Over $7.7 billion in long-term debt is a significant liability, and while they are able to manage it through revolving credit agreements and commercial paper, it's a constant consideration. The ongoing regulatory battles, especially around ROE, also represent a risk. While they're committed to investing in their infrastructure, they are also navigating a complex regulatory landscape where profit margins can be influenced by government bodies. The refund liabilities and the appeals process show this ongoing tension. The company's financial strategy appears to be focused on consistent reinvestment of earnings into their operations to support future growth and regulatory compliance. They are managing the risks associated with interest rate fluctuations through derivative instruments, which is a prudent practice for a company with such a large debt burden. Overall, ITC Holdings is a critical infrastructure company with a stable, although regulated, business model. Their financial health is tied to their ability to secure financing for massive capital projects and to navigate regulatory relationships to ensure fair returns on their substantial investments and successfully executing their extensive capital expenditure plans. And that's our deep dive into ITC Holdings Corp's Q2 2025 report. What are your thoughts on their massive infrastructure investments and the regulatory challenges they face? Let us know in the comments below. If you found this analysis helpful, give this video a thumbs up and subscribe for more corporate breakdowns just like this. Don't forget to join our Discord community for more discussions. Thanks for watching and we'll see you in the next one.